Welcome everybody to the Financial Markets Group organized event on investor expectations and how they move markets in the economy. We are truly delighted to have with us Andrei Shleifer, who is going to talk about this topic. So Andrei and some of his co-authors have developed a new theory about belief formation by economic agents, and have shown that this understanding better belief formation can have far-reaching implications for better understanding macroeconomic fluctuations, credit booms, credit crisis, how the economy recovers from crisis, what policy should be. So this is really important and interesting stuff, and comes at the also at the 10th anniversary of after the global financial crisis, or almost a bit past the 10th anniversary. So it's kind of economic thinking about these topics is very important. And it's really wonderful to have that Andrei Shleifer is working on these things. He's the most cited economist in the world, with thousands and thousands and thousands and tens of thousands of citations about his work. And he has done really important work on corporate governance, on law and finance, on better understanding economic institutions, on behavioral finance. So he has on economic growth, kind of in much of what he has done, kind of many of the areas where he has worked, he has kind of done fundamentally kind of new rethinking of in these areas, and kind of hugely impactful work. So Andrei is a professor of economics at Harvard. He's an editor of the Quarterly Journal of Economics, a fellow of the Econometric Society, the American Academy of Arts and Science, and the American Finance Association. He won the Clark Medal of the American Economic Association for the best economist under 40. So he's extremely distinguished. So let me say, so we're really truly delighted to have him. Let me say a few things about the logistics before I hand over to him. Andrei will talk for about 30 to 40 minutes, and then there will be questions, and we're going to organize the Q&A. I will tell you how when we get there. So also the research that Andrei will tell us about has been developed in a series of papers, but now is also in a topic in a book that Andrei has written with Nicola Gennaioli, who they have worked together on much of this research. So, and Andrei, the book is actually for sale outside the old theater. And those of you who have bought the book and want Andrei to sign it for you, he will be happy to sign it at the end of the event. All right, so without saying much more, let me hand over to Andrei.
Well, thank you very much, and thank you, Dimitri, for the introduction, for a very nice introduction. I was actually thinking that I first visited FMG, the Financial Markets Group, in the late 80s, because most of you weren't born yet, when it was just started by Mervyn King, who was a public finance economist who was kind of dabbling in financial issues. So I think that you can say that all good things start with, or many good things start with FMG. Mostly I was visiting my girlfriend, who was working in the city, and whom I now have been married to for about 30 years. So it was a long time ago. So this is a talk about this book that I wrote with Nicola Gennaioli last year. And I should say it's actually quite an academic book. After it was written, and about 3 months before it was published, the publisher decided that to give it a very, very colorful cover in the hopes of selling it at airports. But I don't think it quite worked out, even with a colorful cover, but maybe some of it is worth a read. Okay, with that, let me just try to introduce the book and some of the ideas in the book, And I'll talk for about half an hour and then maybe open for questions. So the book is essentially about trying to understand financial crisis and try to understand the mechanics or the mechanisms of the financial crisis, how they come about, but also try to ask questions such as, can they be anticipated? Can an economic policy do something to prevent them? A crisis, something that come from the sky, totally unexpected, or are they slow coming? Now, we thought at the time we started writing the book that it was a fairly straightforward question. That is to say that the answer is that the crises are slow coming. But then, right on the 10th anniversary of the Lehman crisis, the protagonists of American economic policy during this period came out in force, actually in very coordinated force, trying to say the reverse, the opposite, which is to say, according to Tim Geithner, who was the head of the New York Fed and then Secretary of the Treasury, financial crisis can't be reliably anticipated or preempted. That's a very strong statement if you think about it, although unless you put a lot of weight on the word reliably, which provides some cover for the statement. According to Hank Paulson, my strong belief is, who was Secretary of the Treasury at the time of the Lehman crisis, my strong belief is that these crises are unpredictable in terms of cause or timing or the severity when they hit. And finally, according to Ben Bernanke, who was the chairman of the Fed, the American Central Bank, this crisis involved the 21st century electronic panic by institutions. It was an old-fashioned run in new clothes. So these statements kind of gave the book a little maybe juicy relevance, because one of the things that I'll try to convince you of in the next 30 minutes is that all these statements are false. So what are the main points of what I'm trying to say? Again, there are probably three. There's been a huge revival of research in credit cycles since Lehman, which shows that they follow credit expansions, a very long time coming, and in part predictable. So again, in part, that is to say they're not perfectly predictable, but there is a fair amount of predictability. Second, the US housing bubble, and I should say, and I apologize for that, that this book takes an extremely US-centric perspective on the events of this period, and obviously there are important international issues, but I will not talk about them. So the US housing bubble and the crisis of 2008 look very much like a standard credit boom followed by a crisis and a recession. It's also similar in patterns of expectations, and I guess that's the main innovation of the book, with enthusiasm about housing and MBS supporting the credit boom, but also for both markets and policymakers, a failure to anticipate the crash, even though there were many signs that I'll talk about of extreme financial fragility. So let me just introduce the topic by showing you some of the credit cycle facts that have been established by various authors. The research that the book summarizes, or some of the new research, since there are lags in publications, is now a year or two old, and in the 2 years there's been a lot more things, so much of it pointing in the same direction. So this is from a study by Shleifer and Taylor, two economic historians, which basically looked at many countries over a period of something like 150 years, and looked at the relationship between the growth of credit, the growth in the quantity of credit, and the probability or the risk of a financial crisis. And they found this positive correlation in the data, which is to say that if you have particularly rapid credit growth, that substantially raises the chances of a financial crisis. Maybe somewhat more refined study by Mian, Sufi, and Werner looked not so much at the crisis, but at economic growth, and found likewise that if you look at expansion of credit, and they focused on household credit, which is usually associated with housing bubbles, that they found that particularly rapid growth of household credit is associated with slowdowns in economic activity in the subsequent period. Again, a negative correlation between credit growth and future economic growth. And finally, there is a study that I wanted to point to by my colleague Jeremy Stein and two of his colleagues at the Federal Reserve, which looks not at the quantity of credit, but at indicators of credit market frothiness. And there are a couple of those. There are things like credit spreads between risky and safe debt, but also a variable, a measure that has become quite prominent, which is the share of risky debt issuance in total debt issuance. And what they find is that when these indicators are high, which is to say when credit spreads are low, or when the share of risky debt in total issuance is high, which suggests that markets are willing to absorb risk at relatively favorable prices, that those credit market conditions portend of slowdown in economic activity going forward. Again, these are not the only studies, but they all show that credit expansion, and particularly the expansion of risky credit, predicts slowdown of economic activity and maybe crisis. Now, what are the views? What can that mean? What are the interpretations? Well, economists have been talking about this forever, but I would kind of distill the interpretations into two very broad categories. The first category, which I would call the traditional view, and I associated, I guess, in the more recent history with Ben Bernanke and Diamond and Dybvig, is the idea that you have an economy that's kind of rolling along, doing well, but not particularly in any kind of abnormal conditions. And then it gets hit by a bad shock. That bad shock could be some bad signal, what economists sometimes call a sunspot, or some bad fundamental news, or a spike in credit spreads. And that this piece of bad news or this shock precipitates all kinds of amplification mechanisms or unraveling mechanisms that bring down the financial system. One of these amplification mechanisms is bank runs or the withdrawal of short-term debt finance from the financial system or from firms. One of the problems is illiquidity. More recently, people emphasized adverse selection problems in credit markets. There's all kinds of amplification mechanisms that may play a role, and that these amplification mechanisms lead to the reduction in the balance sheets of financial institutions, and from there, through the credit channel typically, to the reduction of economic activity. Now, the key feature for my purposes of these traditional mechanisms is that they're rational expectations mechanism, which is to say that there are no errors in expectations, no bubbles, no irrationality in the system. It's just an aggravated response to a piece of bad fundamental news. Now, an alternative view, which I think most economists associate with Minsky and Kindleberger, focuses on belief mechanisms and bubbles, and says that, in fact, you have financial crisis typically on the back of the collapsing or financial bubbles, and particularly financial bubbles that are financed with credit. So the argument would be that some combination of excess optimism, perhaps in response to good fundamental news, leads to excessive lending and investment, that at some point this credit boom runs out of steam, maybe because of a bad shock, maybe because the fundamentals turn out to be not as good as people have anticipated, that this leads to a correction in expectations, and again, then the same set of amplification mechanisms as in the traditional story sets in, which is as people correct their excessive optimism, that this can lead to bank runs or withdrawal of credit from the financial system and then by the financial system, and the recession. But the key point or the key difference between this view is that crises are due to non-rational beliefs, which may be amplified by the traditional mechanisms, but the central point is that the focus on these non-rational beliefs is central to understanding the story. Now, let me give you a couple of pieces of evidence in favor of this non-traditional view. And again, the fact that it's non-traditional doesn't mean that it's new, because as I said, it's been around for at least 40 years, and you can trace it to Bagehot and much older writings. So this is a study of Greenwood and Hansen, which I've already alluded to. This is a study that Jeremy Stein relies on in his work, which it basically looks at this indicator of credit market frothiness called the risky debt share, which is the share of risky debt in total credit issuance. And what you see is that at least if you look at financial markets, when this share is high, the return on corporate bonds with risky debts going forward are low. Now, why is that important? Well, in financial economics, predictability of returns is the first sign of errors in expectations, which is to say that the strongest prediction, perhaps, of market efficiency is unpredictability of returns. And so once you see the kind of predictability that you see in this picture, you need to begin thinking about the rationality of markets. Another picture, which is from a study of Barron and Wei Xiong, looks at another indicator, another set of indicators of impending financial crisis, which is return on bank equity. And what they show is that during financial expansion, you generally see very high returns on bank equity, but that these returns begin to deteriorate. And in fact, they've had some follow-up work which suggested deterioration of poor returns on bank equity are predictors of future financial crisis. So again, you see predictability of returns, which is generally not a feature of rational expectations equilibrium. Now, what does the crisis of 2008 look like? Well, it looks exactly like the Kindleberger-Minsky view of credit cycles, which is that if you look at the facts, they follow exactly the standard pattern, both in terms of the actual quantities and prices, but also in terms of expectations. So just to do the simple history of the crisis in 5 minutes, this is Robert Shiller's picture of U.S. home prices over the course of the 20th century. And you see home prices roughly constant over much of the 20th century, then exploding between mid-90s or early 90s and 2006, only to show a very sharp decline and subsequent recovery after the economy stabilizes after 2006. So the collapse of the housing bubble seems to be a very important feature of what happened during this period. The financing of the housing bubble was through debt and mortgage markets. This is the picture of the expansion of U.S. household debt from 4 trillion to 14 trillion over the period of 25 years, just like as in Mian, Werner, and Sufi paper. This is a picture of the expansion of risky debt, or share of risky debt in total debt issuance, except it's not corporate debt, but mortgage debt. And you can see that what happens, particularly after 2003, that there is huge expansion of risky borrowing or risky mortgages that are subsequently securitized in the US markets. So you do see origination of particularly risky debt as a sharply rising share of total originations. Again, very much as in the Greenwood and Hansen kind of perspective on the crisis and the Stein perspective on the crisis. You see increases in leverage of financial institutions and not just household, particularly after 2004 in the United States in the 2 or 3 years prior to the crisis. And then you see what happens when the housing bubble begins to deflate, which is, again, a fairly standard story, which is to say when the housing bubble begins to deflate, mortgages begin to default, and then they begin to default, particularly most recent mortgages seem to be defaulting first, that this defaults of mortgages lead to declines in the prices of mortgage-backed securities, in holes in the balance sheets of financial institutions, and then the amplification mechanisms set in exactly as in the standard story. So this is probably one of the clearest pictures of this. What this picture shows is the prices of various tranches of mortgage-backed securities in the United States. The picture shows that the risky tranches, that is to say the most junior tranches, begin falling in price. I don't exactly understand where that comes from. Okay. I was talking into some microphone. Just don't know which one. They begin falling right away. And then a few months later, even the safest and most secure tranches of mortgage-backed securities begin falling in price. So you have the same mechanisms of fire sales and amplification that you would see in a normal crisis. Now, very importantly, sometimes after home prices begin falling and mortgages begin defaulting, you have kind of, again, the usual manifestations of a crisis. So one of them is bank runs. The first runs, of course, happen not on banks, but on shadow banks. And this is a figure of the amount of asset-backed commercial paper outstanding, which is a short-term instrument, which is essentially collateralized by mortgage-backed securities. And you see that that market collapses in the spring of 2007. So after mortgages begin to default, after that, short-term financing begins to evaporate from this market. What is interesting is that US authorities are concerned about these developments. It's not that they ignore them. And in the summer of 2007, they begin to intervene. But they see the problem very much in line with the traditional view as a liquidity problem, which is that the view is that if you only stop financial institutions from liquidating assets, then everything will be back under control, and that you shouldn't worry about their capital, you should worry about their liquidity. And so the Fed begins a series of programs to provide liquidity to financial institutions. This figure shows volatility or the behavior of VIX in the US stock market. And you see the world is very, very quiet prior to the summer of 2007. Volatility is extremely low. Okay, so markets certainly are not anticipating any trouble ahead. Then volatility jumps up, but then the interventions from the government are extremely effective. And so volatility is stabilized by these interventions until September of 2008 and the Lehman crisis. So this picture actually raises a set of very interesting questions about why is it that the arrival of the crisis, and it's actually an essential question to thinking about fragility more generally, was so slow. Why is it the case that we have a whole year from basically very substantial tremors in the financial system in the summer of 2007 until the Lehman crisis? And so when we think about policy and when we think about interventions, we don't want to think about, why didn't the Fed understand there was a housing bubble or anything difficult like that, but rather, could the crisis have been anticipated? Could the crisis have been prevented if there were more aggressive policy interventions during this year between, let's say, the collapse of the asset-backed commercial paper market and Lehman? And I'm going to say a few words about that. So, as I said, the economy, the financial system deteriorates very, very slowly from between the summer of 2007 and the summer of 2008. And then over a weekend in the middle of September of 2008, the system collapses through the bankruptcy, starting from the bankruptcy of Lehman Brothers. Now, I'm not going to talk about Lehman Brothers too much. I'm very happy to answer questions about it. But that is clearly the defining or the precipitating event of the major financial crisis. But what I was trying to tell you by telling this story or giving you these pictures is that Lehman didn't happen out of the blue. There was a lot of stuff, a lot of important events to the expansion of the credit bubble and to the collapse, with the collapse of the credit bubble that happened prior to Lehman. So this is a picture of Lehman and standard flight to safety where the assets move out of prime money market funds, which invest in securities other than government bonds, and into government money market funds, and also into commercial banks that have deposit insurance. So the flight to safety is, again, a pretty standard phenomenon. Now, one point I want to make is that the exact mechanisms of how Lehman propagates and destroys the financial system or puts a huge hole in the financial system were very, very standard and understood by financial economists. That is to say, those are the mechanisms of withdrawal of short-term finance, or you could call it bank runs, liquidations of assets, further deterioration of the balance sheets of financial institutions of holders of assets, further failed attempts to raise capital because of the deterioration in the quality of balance sheets, a cycle of liquidations and fire sales, and so on. These are not new mechanisms. How the crisis propagated after Lehman is again, a very, very standard story. The question is, could Lehman or something like Lehman have been anticipated? And could anything have been done in advance? So this is just a picture of a fire sale, of a classic fire sale, which is that this is what happened to the prices of AAA-rated mortgage-backed securities. And you see this tremendous decline, even starting before Lehman and accelerating after Lehman, followed by an extraordinary recovery over the following 3 years. Now, one final slide on the question of anticipation. Financial regulators and policymakers, as well as markets, had a very clear idea that the financial system is in trouble. So this is the data on kind of publicly released forecasts or estimates by the International Monetary Fund on the losses to the financial system. In October 2007 already, these losses are estimated to be $200 billion. Again, not life-threatening for the banking system, but not trivial. In March 2008, IMF estimates $720 billion of global losses in all securities and $200 billion of US bank losses. I mean, this is real money at this point. In October 2008, and these are the estimates before Lehman, the loss estimates are close to $1 trillion with $400 billion of US bank losses. And of course, the Fed and the Treasury have their own estimates, which are probably fairly similar. So all of this is to say that Lehman is not something that came out of the blue. It had a long time coming. Now, given that it was a long time coming, what were they thinking? How do we think about the financial crisis? Why was there this quiet period before Lehman? What were the beliefs that micro-founded or supported the credit expansion of the housing bubble in the first place? Now, so how do we answer these questions? We answer them first by looking at data on beliefs. And here, it's again, the story is pretty consistent with the standard narrative. So this is, again, there are many, many studies like this today. This is a story of beliefs about home prices that from the data by Robert Vishny and his collaborators. And it basically says that prior to the crisis, people believed, at least in the hot areas of the United States, or hot home price areas of the United States, that trees do grow to the sky, which is to say that people expected over the following 10 years to have 10% a year appreciation of home prices, which is not something that happens very often. This is perhaps an even more informative picture, which is about the forecast, the scenarios for future home price appreciation and scenarios for the portfolios of losses on mortgages. So HPA here stands for home price appreciation. And you will see in this figure that Lehman, in this case, these are forecasted 5 scenarios for home price appreciation over the following period, starting in 2005. So the aggressive scenario was 11% a year for the life of the pool of mortgages. Not surprisingly, there are no losses associated with that. What's interesting is that they attached a 15% probability to that event. The next event scenario was 8% home price appreciation for life of the portfolio of mortgages. That was also given a probability of 15%. Then the base scenario, which was given a 50% chance, was a 5% appreciation for life of the portfolio. And then pessimistic scenario was no growth for a couple of years, followed by resumption of rapid growth after that. And only a 5% chance was attached to the meltdown scenario, in which the home prices declined by 5% for the following 3 years, but then resumed growing by 5% thereafter. I should mention that what actually happened was much more extreme than the meltdown scenario. So there's clearly enormous optimism about home prices and mortgages that was built in to the pricing of debt. Now, what about economic forecasters and the Fed, and in particular, did they understand after home prices began falling that the economy and the financial system are at risk? So the next 2 figures speak to forecasts of economic growth, one made by the Survey of Professional Forecasters, and this is the average of professional forecasters of the economy, and the other one by the Fed. And what you see is the light line is the forecast of the US economy at a given point in time, forecast of economic growth. and the thick line is the actual growth. And you can see that that slowly you see some declines in the expected growth rate, but it's still over 2% in 2007 and 2008. And you can see that the professional forecasters, as late as the summer of 2008, completely miss the risks that the US economy is facing, and only revise their forecast down sharply after Lehman takes place, after Lehman crisis occurs. What about the Fed? Well, this is better. So the Fed also slowly reduces its forecasts. It has a meeting on August 5th of 2008, 6 weeks before the Lehman crisis, at which the Fed forecasters actually revise upward the estimate of the future of the growth of the US economy over the next 12 months. Okay, so again, you can say whatever you want about the extent to which the policymakers anticipated the crisis or thought about the crisis or understood what was going on in the financial system. But it's very clear that at least the Fed staff totally missed the crisis. It actually gets better because for that meeting, the Fed staff is asked to describe what would happen to the US economy in the scenario of a severe financial stress, which was actually defined for them, that credit losses and solvency concerns intensify for many financial institutions, restricting their ability to supply credit and causing them to tighten lending standards more than in the baseline. In this scenario, the Fed forecast is expected a small slowdown of real GDP growth in the second half of 2008 and the resumption of real growth in 2009 and 2010. Again, the Fed totally missed what was going on, even in the doomsday scenario. So, why was Lehman so pivotal? Well, it appears that, in fact, it was pivotal because both the policymakers and financial markets understood that their beliefs about the level of financial fragility in the US economy were mistaken, and that contrary to their beliefs that, in fact, the economy was in a relatively safe situation, it was in a much more vulnerable situation that ultimately led to a huge crisis and a major, major recession. So that's more or less the story. Now, what the book is about is basically formalizing the story and is trying to build models of belief formation that incorporate phenomena such as neglect of downside risk and extrapolation of prices in a unified framework. So let me take 3 minutes to describe this model, and then I will say a few words about alternative formulations, and then I'll conclude. So the model of is something we call diagnostic expectations, and it's the idea, and it's based on the idea that people adjust their beliefs in the direction of states of the world that are most compatible with the news they receive. So that if good news lead to the shift of beliefs in favor of states of the world that are most consistent with good news. Not a particularly striking idea, but it turns out to be a notion that unifies a lot of the evidence. So to make it big specific, let me ask you a question. I'm going to need some estimates, okay, from the audience. What fraction of people who live in Florida are over 65 years old? Yes. How many? 30%. How many? 60. Any others? 17. Well, thank you. You're a good reader. It is 17%. Now, what is true is that, in fact, it's 15% in the rest of the United States. And it is the case that Florida is disproportionately elderly. But of course, the idea here is that when people make the estimates, the stereotype of the Floridians is that they're elderly. And so people go too far in putting weight on the states of the world or the fraction of the Florida population that is over the age of 65. I could do one more. Suppose I tell you a person is Irish. What are the chances they have red hair? Need some estimates. 5%. How much? What was there was some estimate. 5%. 5. Okay. Do I have any more? 30. Thank you. Any more? I need one more. 2%. Well, okay, this one, it didn't work as well. It's actually 10%. People usually estimate a higher number than 10. But you've had you were primed by the Florida example, so you didn't fall for this. It is only 1% among the rest of the Europeans. So again, the incidence of red hair is 10 times higher among the Irish than it is among other Europeans, and it's even more so if you look at the rest of the world. But the difference, and so again, people adjust too much in that direction. Now, this is the social psychologists call this phenomenon the kernel of truth property of stereotypes. And it is really universal in how we form expectations or beliefs. It's true about political beliefs. It's true about beliefs about social groups. It's true about beliefs about genders. That is to say, the differences get amplified between groups, get amplified in belief formation. And so we take that idea, we formally model it, and then we say that this is actually what happens in expectation formations in financial and macroeconomic context, in that people informing their beliefs as they receive information put too much weight in situations that are distinctive about this news. Okay, so just like people too much weight on the Floridians being elderly, they put too much weight on the possibility that increases in home prices or other good news about housing mean that there is going to be a continued housing boom. And so we take this idea and we show that, in fact, neglect of downside risk and optimism are part of the same belief formation mechanism. And I should say that if you look at stock prices, if you look at actually a range of phenomena from beliefs about how good different genders are in different fields, or beliefs of stock returns, or beliefs about political preferences of people on the left and the right, you find the same phenomena. So for example, people believe that the differences between the left and the right are much more extreme than they are in reality. Anyhow, that's my digression on belief formation. If you want to know more, you have to buy the book, or at least borrow it. Okay. Now let me say just 2 words about the alternative theories of the financial crisis or financial fragility that I want to emphasize. The first one, which is very, very, very dominant, it's particularly dominant here, even more so than in the US, is the idea it's the big bad banks that tricked everybody. And I'm not suggesting that the banks are small or that they're good, but I am suggesting that if you actually look at bubbles, people's beliefs about the future, financial institutions' beliefs, policymakers' beliefs, households' beliefs are more similar than they're different, which is to say that when you have a housing bubble, most participants in the economy tend to exhibit similar kinds of optimism. So this is not to say that banks weren't gambling, but rather but to say that they were just as optimistic in most cases about housing investments as everybody else. The second point, the second alternative theory that I want to say something about is this bank runs, or the traditional view, which is, again, I don't want to say that bank runs are not important for financial crisis, but rather that they happened at the end. By the time you have a bank run, it's not that bank runs come out of the blue and strike a healthy financial system. Okay, that happens in the Mary Poppins story, but it doesn't really happen in the world. By the time you have a bank run, the financial system is already near death. And so thinking of financial crisis as bank runs is like thinking about heart attacks without thinking about heart disease. Okay, it's just a very misleading way to analyze the problem or to think about the problem. Okay, so let me just summarize. Extrapolative expectations seem to be central to the housing bubbles. I think we need to appreciate the continued neglect of downside risks, which I've shown you through expectations data, as being central to thinking about 2007, 2008, or the delay. I think when we think about economic policy, at least in the United States, I think it's important to recognize that it was absolutely fantastic after Lehman, and that, you know, the financial system in the US was essentially cured by spring and certainly the summer of 2009. And you could have perfectly well imagined that there would be the hiding of bank losses or the refusal to recognize the issues and the kind of prolonged depression as one saw in Japan in the 90s and 2000s, or in Italy that we see today. So none of that has happened, and I think the policymakers get a lot of credit for that. But that is a different statement than a statement that they were on target prior to Lehman, and I think it's a more accurate description is that prior to Lehman, they were probably behind the curve. And finally, the basic message is that it's very hard to tell the story of the crisis, of this crisis, or of any other crisis, without a focus on beliefs, and that part of the message of this book is that one needs to bring survey expectations or beliefs back into economic analysis, back into macroeconomics, and back into finance. Thank you very much.
So, let me use my privilege of being a chair to ask the first question.
But you're going to say the first six, okay.
No, just the first one. So, but you can, okay. So I want to kind of, maybe you can tell us a little bit more about the policy implications about this whole thing, that kind of your whole view of the world based on beliefs. So, so you described this, you gave us this view of credit cycles that kind of come from extrapolation of beliefs by individuals. And actually, in some cases, even policymakers, you saw that even policymakers have their wrong, seem to extrapolate. So what does this, how should policymakers do things differently than what they have done them so far? Why have they been doing things wrongly so far? Or and also, maybe in your answer to that, maybe you also take into account, maybe you can take into account the fact that some of these events have happened maybe because of uncertainty that policymakers created themselves. I mean, the fact that Lehman was saved and not another bank was saved, or for example, in the context of the Eurozone crisis, there was quite a bit of, there was low volatility before the crisis because it was, maybe many in the market believed that countries in the Eurozone would not be allowed to be to fail. So somehow there is some of the uncertainty themselves itself is in the actions of policymakers. So anyway, so.
Well, I need.
So maybe it's more than one question, but anyway, you can pick up whatever you want of this.
I need two more.
All right, let's okay, fine. Let's take some more questions.
No, I'm going to answer it, but you told me you set the rules. You can't create so much question uncertainty.
All right.
And yes, please. Are you?
Yeah. That's fine. Yeah, please.
Yes.
Where's the mic?
Oh, I don't know how that works.
No. Let's get the mic here.
If you'll permit me, maybe I'll give you two short questions to get to the first three, which is just looking backwards. I was surprised you didn't mention Bear Stearns, which was a firm very similar to Lehman's, and the difference between the Bear Stearns collapse and the Lehman's collapse, which was the sort of the regulator incentivized intervention of J.P. Morgan. I should say I work for Bank of America. The forward-looking question actually is where do you think we sit now? I'm not sure if household debt is at the same levels, but overall corporate debt has risen very sharply due to, and certain sovereign debt has risen very sharply due to accommodative policies from central banks. So from what we've learned in the past, how do you feel where we are in the credit cycle now?
Okay, so I think actually the first two questions are related, which is what are the policy implications? I think, let me abstract away from the question about what is politically feasible, because, you know, the first line of defense of U.S. policymakers, at least after Lehman, which is a position they've maintained for quite some time, is that, but have changed last September, is that the political constraints were such that they couldn't do much before Lehman. And that may be true. I don't know the answer to that one way or the other. But, you know, what are the policy implications, let's say, in the absence of political constraints? It seems that the most fundamental message here for policy is in favor of early action. Which is to say that if you have a situation, if you believe this data, in which, well, let me say two things. First of all, it looks like policy has really a long time. If you believe the evidence on how long it takes financial crisis to develop, it's not that policymakers need to act overnight as they did after Lehman. They have months and maybe years. And I think that is something that's generally at least used to be a subject of agreement among people who study these matters. So if you have months or even years, it seems that what this line of analysis points to is the desirability of early action, where the early action takes the form of boosting the balance sheets of financial institutions or banks, whether it takes the form of trying to stabilize the financial system through mergers or other means. There is a lot of things that one can do. In this regard, bringing up Bear Stearns is very important because the U.S. policymakers did have the option in March of 2008, after the rescue of Bear Stearns, to make the statement, you know, never again. We're not going to bail out another bank. We're going to put enormous amount of pressure on banks to cut dividends, to stop paying dividends. We're going to put pressure on banks to raise equity. Very little of that has been done. As I said, the original defense was that it was politically infeasible. But you asked me, what is the optimal policy? So if you believe this point of view, the policy is very clear, which is to say that if you see, even if you cannot tell whether something is a bubble or is not a bubble, one of the things, once it begins deflating, you need to work on the capital of the financial institutions right away. Again, one of the arguments that's been made by U.S. policymakers is that they couldn't have said, you know, in July or August of 2008 that the financial system is extremely vulnerable, because that itself would have caused uncertainty. But my point here is that it really took a year and a half, okay? And, you know, even if Ben Bernanke had to make the speech that he did at Jackson Hole in August of 2008, he didn't need to make that speech in March of 2008. And so they did have a lot of time to act. And I think that is probably the central policy implication. Now, with respect to today, I think your guess is probably as good as mine, maybe better actually, given that you work for a bank. But it seems to me that it takes two components to have a financial crisis. One is extremely, maybe three components. One is extremely extended leverage. We certainly do have that today. One is vulnerability to a shock. We certainly have that today, probably as much or more as in 2008. And three is extremely leveraged or undercapitalized financial institutions. And I think the central argument for the belief that today is much safer than 2008 is the third piece, which is somehow banks are much safer today and much better capitalized today than they were 10 years ago. And so if you believe that, you can sleep well at night.
Okay, perfect. Let's take some more questions. So, all right, so 1, 2, 3, and then I will start taking questions from up. Let's take some. Okay, so one to the gentleman here, please.
Paul McGrail, Peace News. Could you say a word about what's commonly referred to as shadow banking, and to the extent that do we really know how much credit and leverage and liquidity is actually there? Can we quantify the aggregate?
And there were two more questions there in the back. Yeah, one and then two. So yeah.
Andrei, my name is Henry. I work at Morgan Stanley. I have a quick question to you on the corporate tax reform. So far, we've seen the corporate tax reform mainly leading to an increased buybacks. What is your view on the corporate tax reform? Would you expect that to lead to higher capex spending levels going forward as we approach the start of a new capex cycle, or what is your view here?
Okay, and one more question to the gentleman next to you.
Hi, my name is Ashraf from the Sorbonne Business School. So knowing that private debt has a lot more regulatory leeway than regular debt, how do you feel that...
I'm sorry, could you repeat?
Private debt has a bit more regulatory leeway than regular debt. How do you feel that investors will react to what is the investor mindset on the private debt asset class?
As opposed to what debt? Sovereign debt, you mean, or what debt?
The regular debt, banking debt.
Oh, you mean bonds as opposed to banks?
As opposed to private debt, like the asset class private debt, like as an alternative asset? Like, you know, private equity, private debt, like a lot more,
Maybe we'll take one more.
Yeah, let's take one more question.
I'll try.
Yeah, and okay, yeah, so, yeah, up, the gentleman there. Yeah, can you?
Hi, my name is Anchit. I'm a general course student, and my question is pertaining to the view of the financial crisis. So Mian and Sufi argue that the financial crisis was based on an active credit view, that it was driven by an expansion of credit availability. And Foot et al. Argue that it is based on a passive credit view, that it was driven by speculative investors. My question is, what view do you think it actually was? And whatever view it was, what do you think was the solution to this? Would it be better to for the central bank to go for a mopping up the mess strategy or a leaning against the wind strategy?
Okay, let me try. I mean, these are hard questions, and I'm not sure I understood exactly what people have in mind. With respect to shadow banking, remember that, at least in the United States, the term is somewhat misleading because shadow banking in 2008 referred to financial institutions such as investment banks, which were very far from being in the shadow. And so since then, of course, all of these institutions in the United States, or all these major financial institutions and investment banks, have come under the umbrella of being regulated by the Fed. And so in the U.S. at least, it doesn't mean that there aren't some institutions or some credit that is being generated outside of the regulated banking system. But in most financial crises, the problem is not in the shadow. The problem is in the core. I mean, it may be different in China, it may be different in some other countries, but I think it's pretty important to appreciate the fact that most of the vulnerabilities are actually in the regulated sector, and these vulnerabilities accumulate not because the regulator has no regulatory power, but rather because the regulator either doesn't believe that there is a problem or is not politically able to address the problem. So I don't think that blaming everything on shadow banking in 2008, and even more so if we have a problem today, is right. In terms of bank debt versus private debt, I'm not going to answer the question about the corporate tax reform, not because I don't have views, but because those views are totally uninformed, and I'm not going to bother the audience. In terms of bank debt versus private debt, again, I want to stress the point which I think is central, which is that in financial crisis, both in terms of the periods leading to financial crisis and the crisis themselves, these markets often move in tandem. And they move in tandem because of incredibly powerful competitive forces that operate in the system, which is to say that banks don't really have a choice not to participate in a bubble, because then the other banks that choose to participate in a bubble are going to eat their lunch. And so typically private debt markets, bank credit, actually move in tandem, and this was one of the messages of the Wei Xiong's paper that I've talked about, and so on. So, the banks are easier, and not only that, the markets are also interconnected, because directly or indirectly, a lot of what you call private debt ends up as an exposure of regulated financial institutions. So I wouldn't stress that distinction. On the question of credit availability, look, I think I'm going to give the same answer, which is I think the evidence that you've referred to, if you want to call it a supply shock or credit supply shock, that seems like to be a fair description. It's clearly a shock to supply, and it's not all just demand-driven. Whether that shock to supply is driven by sentiment of the sort that we talk about in the book, or whether it's driven by some other considerations, is in some sense immaterial. And again, I want to stress that these things are more similar than they are the same, than they're different, which is to say that when you have a bubble, the people who want to buy houses and borrow, and the people who run financial institutions or issue credit likewise believe in the bubble and want to lend. So it's not a question in a bubble of divergent interests or expectations.
Let's okay. Let's do maybe one more round. Okay, 1, 2, 3. Three, and then yeah. All right. So yeah, one. Sorry, there were two hands. So I think there was one. Yeah, you start, and then the gentleman with the blue, and then we'll have one here. Yes.
Hi,
Please go ahead.
I'm Dominic, member of General Public. My understanding about your theory about beliefs is that it often leads to overshooting. I would like you to explain how you think that has, what the predictive power of that is compared to just reversion to the mean. So how does overshooting lead to, this theory of belief overshooting lead to a better predictive power than simply reversing to the mean value?
Yeah, please.
Hi, Stereotypes, I'm a visiting researcher here. Just to pick up on your conclusion that we should bring expectations and beliefs back into finance. I mean, just in exploring that a little bit, just to ask how. We have surveys that say some people think the equity indices themselves are a good leading indicator. Are these the data points we should be using more? How should we be using them?
And the third question was, yeah.
Hi, I'm Giulio Bianchi from the Bank of England, but the views are my own. We focused a lot on credit, but not so much on what actually pushes credit to increase. I'm thinking of sort of longer term trends or so-called fault lines, such as inequality or the savings glut. Do you really think policymakers can constrain credit or actually act early, as you seem to argue, without looking to address such longer term trends, such as inequality or the savings glut? Thank you.
Okay, those are all great questions. Okay, so what this book tries to do, this is the question about are we just talking about overshooting and mean reversion, is to build the foundations of expectations in the same way as economists built foundations of preferences or technology or what have you, which is to say, to start from first principles that are psychological, but also then build models or frameworks that are portable across domains. Okay, that is to say something that, I don't want to say universal, but something that you could use in different contexts. And so when you say overshooting and mean reversion, that is actually an outcome for prices or for other indicators of how people form beliefs. These are words that describe what happens as an outcome. What we want to do is to actually step back, as we often do in economics, and try to understand what are the foundations of these beliefs and how they're tied to psychology. And the reason that I was entertaining you with red-haired Irish and elderly Floridians is because, not because these are funny examples, but because they get us to the foundations of beliefs, so then we could take these models and ask, when do you have underreaction in the data? When do you have overreaction in the data? Why do you sometimes have more mean reversion, sometimes less, so you can make predictions? So that is the structure, or the conceptual structure of the research agenda. Now that leads to the next question, which is how do we bring surveys into finance? Well, it turns out, how do we bring this data into finance? So of course, a couple things. One is that there is a lot of survey data, and these data have been kind of largely ignored in the mainstream of professional economics for 40 years because we had the rational expectations hypothesis. And now we can bring this data back. So here's an example of this, which is to say that, the previous question mentioned underreaction, overreaction. We can actually measure those things in the survey data because we can try to understand, for example, how survey expectations or changing in expectations related to the prediction error, which is to say, probably the most basic implication of efficient markets or rational expectations is that you can't use current information to predict errors in expectations. Well, when people start looking at the data, you absolutely can. That's in fact how we detect overreaction in the data today, which is to say if you revise expectations up and if your realization turns out to be lower than your expectation, systematically, that's evidence of overreaction. So you could actually do a lot with survey data, and this is analysts' expectations, this is macroeconomic forecasters' expectations. In many countries, a lot of data on expectations of managers, of firms, and so on. You could actually measure expectations and analyze them in economic models in exactly the same way as we analyze quantities. And a criterion for judging an economic model can be not just how it predicts quantities and prices, but also whether it predicts actual expectations that we observe in the data. That's a pretty substantial step in expanding the scope of economic analysis, and I would say the credibility of economic analysis. And I think that's where the analysis will go, and at least I hope that's where it will go. Can policymakers look to constrain credit without addressing cosmic changes in the economy? I don't see why not, which is to say that, these forces are obviously very, very powerful, but policymakers' tools are powerful as well with respect to the financial policy and capital and security issuance and so on, fundraising, dividends by financial institutions. So it seems to me, Jeremy Stein, whom I mentioned several times today, when he was a Fed governor, has pointed out on numerous occasions that between Bear Stearns and Lehman, U.S. banks paid out $150 billion in dividends. Again, could the Fed or other regulators have legally stopped that? Probably not. Would they have encouraged a different dividend policy? My guess is that they had quite substantial power to do that. So maybe it requires some cosmic understanding of the major forces, but I think that simpler things could actually have done a lot to alleviate the crisis.
Okay, great. So let's maybe one more.
One more round.
One more round. Okay.
And we'll go to sleep. Yes.
All right. So 1, 2, and 3. So
the gentleman had his hand up for a long time.
This one. Yeah. Number 2. Yeah.
Hello. My name's Jerome. I'm in year 12. I wanted to ask whether, what would be your thoughts on the reason why credit rating agencies rated securities AAA, and also you mentioned moral hazards before in your speech, and I wanted to ask, do you think that the fact that governments were bailing out banks, do you think that would create moral hazards in the future?
All right. Number 1. Yeah. So the gentleman there.
I'm Jacob, a first-year student here. So my question is about the role of investment banks in propagating CDOs, which eventually in 2007 and 2006, the very originators of those CDOs began to actually purchase credit default swaps against them. So if you could address possibly the fact that people within the general network of finance had some understanding that the housing market was going to go to bust, yet there was no policy intervention. Would you say that that was actually the case?
Yeah, one more to the here.
Robert McRae, Systemic Risk Center. You mentioned China, and you're a fan of early action. So do you think China should be squeezing now, or maybe should they have been squeezing 5, 10, or 15 years ago?
All right. So, Andrei, go. That's our last.
Okay, so the first two questions are about big bad banks. So look, again, it is surely the case that credit rating agencies had false models and probably issued ratings that could not be, or incorrect models could not be justified. But I think, again, it is too big a step from that to say that credit rating agencies were somehow fundamental to what has happened. In other words, if credit rating agencies were a bit more accurate, you know, we would have had a lower share of CDOs, of ABS rated as AAA, but it would not have changed the fundamental story. In other words, securitization was an innovation, and the ratings were obviously important for securitization. But it's a small part of a much broader story of credit expansion and a housing bubble that that then deteriorated. So I don't want to put too much weight on credit rating agencies, not because I think they're blameless, but because I'm looking for common features in financial crisis, not differentiation. Likewise with CDOs, you know, the banks were the ones that were holding the CDOs. Okay, so if you thought that they were they an innovation? Yes. Were they an innovation that was ultimately disruptive because it cost the banks a lot of money? Yes. But, you know, again, you can't simultaneously say it is all moral hazard and big bad banks and that banks end up holding the CDOs themselves, which is what they ended up doing. The reason that the banks were holding CDOs is that they believed in the stuff, just like everybody else. On China, look, China is squeezing banks a bit as we speak, a bit. But of course, the central point about China is, you know, it's not a market economy. And so, you know, they may not call it bank rescues. They might not call it the same things as we would call it. But I think that in that situation, the probability that any major financial institution is going to liquidate its assets is, I think, is very close to nil.
Okay. All right. On that note, let's let's close the discussion here. So okay, it was very interesting to have the talk and the kind of the discussion afterwards. So thanks a lot, Andrei, for coming to give us this lecture.